this week I had several coaching sessions. I think I had 8 total. But 2 coaching sessions out of the 8, customers asked about the signature tools, more specifically the strike of pain tool in the signature tools. And there was some, there's a help guide on this page, I thought. Oh, there is a video here. Let me go back to signature tools view. I'm sorry, let's go back to signature tools. Pair your sung in stocks. Yeah, there's a video there where we talk about the signature tools and we review the strike of pain. But both investors I talked to during these coaching sessions had a slight misunderstanding related to the strike of pain. So let's go ahead and just run this. We'll just run it for Apple for next week. The strike of pain, of course, is based on the max pain calculation that came out in mid-'80s, early '80s perhaps. And it was this idea that investors were seeing, floor traders, excuse me, were seeing that the stock that had the option strike, excuse me, that typically had the highest open interest level on an expiration date, leading up 10 days, 7 days to expiration, is where the stock tended to gravitate towards. But then the people who developed the max pain calculation decided, you know what, it's not about the highest open interest of all calls and all puts at the strike price where it's gravitating towards. It's this pain feature. And what is the pain feature? Well, this here, what we're looking at, the orange line here is the pain value. What this represents is if the stock was trading right at this price, what is the pain value that option buyers and of all calls and puts would experience? In other words, this is supposed to be the price where option buyers would realize the most losses for all strikes going in or out of the money in this direction for calls and puts and in and out of the money for this direction. The pain value here at this price is where the stock is expected to gravitate towards. It's not just the highest open interest. It's the open interest calculated. Well, if the stock was trading at 165, how much money would 150 call buyers with this open interest and 150 put buyers stand to lose? Right? How much would they lose? How much would option sellers gain at this price? And that value that you see that's highlighted is the one where option sellers in theory should make the most money based on the combined open interest of calls and puts. Okay, so essentially, where's the lowest pain value? Whereas here we see the pain value, if the stock ended at 70, is pretty darn high. But this open interest is related to the deep in the money calls and what would be deep out of the money puts. And the same thing here. And then when we go to the higher strikes, we have in the money puts and out of the money calls. So the value here with this pain value here is where it's expected the stock to gravitate towards. Where the confusion was is both customers I talked to said, okay, well, those that bought 70 calls, there's 2,462 call buyers here that might experience a large amount of pain if the stock fell to 70. It's combined. It's the combined open interest of the calls and the puts. What would be out of the money puts here and in the money calls at all of the other prices at 75, 80, 85, 90, and so forth. Out of the money puts and in the money call open interest, not just the calls. And these just aren't the puts. It's combined of all the calls and puts open interest at the 190 strike, 185 strike, and so forth used in the pain value feature. And naturally, that leads to a follow-up question. This is telling us that next week we can expect Apple to maybe start to gravitate towards 165 right now, because that's where that lowest pain value is, and that's where the option sellers would theoretically make the most money, and option buyers would theoretically lose the most money. But this is not looking into account of any outside forces that we've been experiencing for the past 2 months or so, meaning that any new developments overseas could be good news for the stock, and we could see this jump up to 165. That's not related to the pain value, because as soon as it goes to 165, what are you going to see? You're going to start seeing some rolling and adjustments, and you're going to start to see shifts, of course, in these pain values and in the open interest as well. Okay, you see a big move. If this goes up 20 points, wouldn't say this was related to the pain value. That's related to other outside market forces, and then we're going to see the open interests start to shift. So on Tuesday, if this does have a good 20-point move on Monday, I'm not saying to expect that with Apple, I'm saying if it did, you're going to see the open interest adjust, and you'll probably see a new pain value, probably at maybe a 175 or a 177 strike, perhaps. It could happen. Okay. So that's something to always consider. This is not looking at outside forces. This is just in a normal market condition when there's not a lot of uncertainty, there's not a lot of volatility, there's not a lot of outside forces that are beyond our control. The market's just gradually moving up, maybe having that melt up that we saw several months ago where we'd go up, over a 5-day period. We'd see SPY go up 3 to 4%, and then we have a 2 or 1.5% decline. Then we go up another 5 days, 3 or 4%, and another 1% decline on a day or 2-day period. On those melt ups, you're probably seeing options right at the money. This would probably be looking at the 155 or the 160. The 155, maybe the 157.5 for March 18th expiration, right near the money. But with things the way they are now, with movements and volatility occurring, Apple's about 10, 12 points above, 11 points above, excuse me. The strike of pain is 11 points above where it is. With things going on, it might be difficult to see an 11-point movement in Apple next week. Okay. The last couple times we've done tests on this, one of the gentlemen here that used to work with PowerOptions, he helped co-author the Iron Condor book with Ernie, Mr. Mike Phillips. He did sort of a test on this, grabbed a basket of stocks and watched their strike of pain from 30 days out to 15 days out to 10 days out to 5 days out, and watched the changes. And then on the last day, sort of gauged what was the success rate of this. And I tried to do something similar to he did back in 2000. His was in 2006. I think he tried it again later, maybe 2009. I think I did mine in 2015 or 2016. We came about the same numbers, and roughly what we came in with was about, let me say it this way. Let's do it with SPY. It's accurate about 55% of the time. Okay, and what I mean by accurate 50% of the time, let's go into these higher strikes. Oh, this is a standard expiration. I apologize. Let me go to March 14th. Okay, let's go to that Monday series here. Okay, it's still not showing me what I wanted to see, but that's quite all right. Oh, it is now. Good. Where's my pain value? Jeez, this is all over the map, isn't it? There we go. 430. And we're at 420. That's not inconceivable. But what I tended to notice is about 52 to 55% of the time, this seemed to work. But to consider it a success, both Mr. Phillips and myself considered, well, hey, at that time, he was doing it in 2006, did it later again, and then I did mine in 2015. We didn't really have these dollar strike differences. We didn't really have at that time. We did in 2015, but not as the amount of stocks that we have right now. We didn't have these weekly options in 2006 really to test this. That's why I was using 30 days out, 15 days out, 10 and 5. I shortened mine in 2015 to look for shorter terms when some of the weeklies were getting bigger and bigger. We were getting more weeklies, I should say. Long story short, I apologize. To consider it a success, we considered it if it was within 1 or 2% plus or minus of the strike of pain value. Okay, well, 2% is, 2% here is $8, $8.60. That'd be a 422 strike, or, down here further, 437 or 438. Why is that relevant? Is because we started to feel the concept. We started to get the sentiment that investors were sometimes trying to use the strike of pain tool to say, hey, 10 days out in time, even though the stock's at 420, SPY is at 420, the strike of pain here is at 430. Let me do a really cheap bull call debit spread by selling the 430 and buying a 425. Okay, and so I'm doing a bull call debit spread here at these strikes, selling the 430 and buying the 425. I probably have a 1-to-1 risk-reward ratio because I'm deep out of the money. It might be even less. But again, hey, plus or minus 1 or 2%. If it goes to 437, great, you've got full profit. If it goes right to 430, you're pretty much near full profit. But 1 or 2%, if it's at 422, you're at maximum loss. That's why we sort of kind of did that research, because we wanted to make sure investors weren't saying, oh yeah, this would be a great strike to sell a naked put. No, it's not. It's in the money. If you have the expectation it's going to go here, look, sell the 415, sell the 416. Don't be bold and try to maximize by selling an in the money put, hoping that it comes up in price. Don't do a bull put credit spread at these strikes just because the strike of pain is there. That's a higher than the current level. Base it on the stock price, not what the strike price is showing you. Because, especially when looking at maybe credit spreads on SPX, 1 or 2, or NDX even, a 1 or 2% plus or minus could be disastrous for a bear call, bull put, or an iron condor. That could be going through your strike price. You're trying to force a 3-day or 7-day out trade. Okay, so I just wanted to mention that real quick, just a little offshoot there, because it came up twice in coaching sessions with the same general question and essentially the same general misconception of what the strike of pain was showing you when you were going through those different values. Okay, so in the meantime, I just wanted to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or trading suggestions. Options do involve risk, as we've seen, and may not be suitable for all options investors. But that's why we're here to try to help educate not only on the strategies, but also on the management techniques, proper position sizing, and more. We did have a chance to go through some of the signature tools today. We did go through the search today. We took a look at the portfolio briefly and ran some analysis on the profit and loss chart. Hey, if you like some of the tools that you saw in today's presentations, remember you can take a 14-day free trial at any time. Just go to PowerOp.com, put in your name and email address, and you'll have access to the search tools for 23 different strategies, creating your own search, signature tools, limited 3 months access of historical data for the back testing tools, of course. No credit card required, a full free 14-day free trial with no obligation. After that subscription levels start, it's just $45 per month for the end of day service. The 12 to 15 minute delayed service is only $65 per month. We do, of course, offer a real-time and the premium service, which includes everything. And of course, at any time, you can access our webinar archive of free education. Just go to powerop.com and click on the free webinars section or free videos. And you can go through the different tools, webinars, options strategies, options concepts, or requested topics. And of course, you can always check out our YouTube channel we mentioned before. A lot of our public videos are posted there, of course, as well. And last but not least, I didn't see any last-minute questions come in, but if you do think of another question over the weekend, okay, Marty, I'll go through that in one moment. We did get one question, but remember, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. And remember, of course, trial members and subscribers can schedule a free coaching session at any time. The free coaching session is it's just a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have.